Hi there, my name is Dan Page and I'm the president of Boulder Equity Partners. I'm here today to talk to you about bridge loans versus long-term loans and the effect that the recent increase in Fed rates have had upon both of them. Before we jump into that, let's do a quick background. I've been in the commercial finance industry over 30 years. I've closed well over $1 billion in transactions and counting. I'm the go-to guy for thousands of commercial mortgage brokers, and I review 10, 15, or more submissions on a daily basis. So I have my finger on the pulse of what's happening in the industry and why that's important to you. So if you're looking for a loan for your commercial property, by all means, you should be looking at interest rates. We all do. Long-term loans typically have a much lower interest rate, usually is at least a 4 to 5 point spread between the two of them. Bridge loans typically tend to be more expensive, at least in the short term, although there's usually a great reason for both of them, all depending on your unique needs. However, today, that increase in the Fed rate has dramatically affected long-term rates with much less of an effect on the short-term rates. What that means for you is that the gap between bridge loans and long-term loans has closed dramatically. It's down to a 1 to 2 point difference, and quite often those monthly payments are pretty much identical. Bridge loans also have other advantages. They're much easier to fund, less requirements, less paperwork, they fund faster, there's little to no prepayment penalty in comparison with long-term loans. Bridge loans payments are interest only versus principal and interest for a long-term loan, which means long-term loans typically are going to have a little higher payment because you're mixing both principal and interest together in the same payment. Monthly payments for bridge loans and long-term loans can be equivalent now because of that increase in long-term rates. So let me give you an example. If you had $1 million long-term loan right now with a rate of about 7.5%, which is where it tends to be, I've seen rates from the low sevens all the way up into the high nines, even higher for long-term loans, all depending on all those variables that go into the loan. So if you had $1 million loan right now, 7.5% rate, 25-year AM, your monthly payment would be about $7,400. Whereas that same long-term loan, $1 million at a 9% bridge rate, your payment's $7,500. They're almost identical. So now may very well be the perfect time for you to be thinking about a bridge loan versus a long-term loan, especially where rates are high right now, much faster close, and plus the issues that might get in the way of a long-term loan, like late payments, mortgage rates, credit issues, unstabilized properties, all of that pretty much disappears with a bridge loan. So by all means, don't get me wrong, there's absolutely a fit for long-term loans, and they're very, very appealing. I just want you to be able to think about both and go in eyes wide open when you're thinking about what the best decision is for you at the moment. And for now, bridge loans can buy you a little bit of time, because if you want to make the bet that long-term rates are going to come down the next couple of years, a bridge loan might be the best fit for you right now. So by all means, we'd love to talk to you. Boulder Equity Partners has been a commercial real estate lender for many years. We have both long-term and short-term loan programs. We fund a whole plethora of different types of properties, including investment, residential, office, retail, warehouse, restaurant, light industrial, all sorts of different properties. And we have a highly experienced staff, and we'd love to be able to help you. So thank you very much, and I hope to talk to you real soon.